Hello and welcome to the DIY Investing YouTube channel. We're working through every company in the S&P 500 and today is Corning Incorporated, ticker GLW. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. First up, this company has a market cap of $29 billion, enterprise value of $34 billion, so you have about $5 billion in leverage on the business. That should boost your return on equity properly handled, higher than your return on invested capital. Now you have electronic equipment, instruments, and components industry, usually not the best industry, but of course it depends upon what they're doing. They engage in display technologies, optical communications, environmental technologies, especially minerals, life science businesses. So companies, display technologies segments offers glass substrates for LCDs, OLEDs. So we got television notebooks. It has optical fibers and cables, specialty materials, glass ceramics, ultra thin wafers. So basically materials into various parts of electronic equipment. So again, probably not the best industry. If you think about like televisions, computers, those have been coming down in prices for decades. And so there's probably a lot of competition on price. We'll see if that plays out further on. Now, return on invested capital. First thing I want to see is 20 straight years of profitability. The more years of losses, the worse the business is. And here we see 4 years of losses in the last 20 years. Now, I would like to say for a high quality company that you have 20 straight years of profitability or potentially 19. 1 year of loss is acceptable over a 20-year period, but 4 is a little high. With that said, since 2005, you only had 1 year of losses. It's been pretty stable since then. So maybe this is a different period, 2002, 2003, 2004. Obviously, there is a recession timed here, but you can see in the 2009 recession, they didn't have a major problem either. So they still did well there. What that means is that, yes, there is 4 years of losses over the last 20, but there's only 1 year of losses over the last 17. So it's a slightly different story if we play this out for the next 3 or 4 years. With that said, though, when I look at this chart, it's not stable. You're jumping around a lot. You get up to 40% return on invested capital in 2008, 21% in 2007, 12% in 2009. Every single year you see massive changes, whether it be from 12% to 18%, 18% to 12%, 12 down to 6. There's no stability here. It makes it very unpredictable. The less predictable a business is, the lower quality it is. So for what I see here is this is probably average business. You don't see tons of losses, but you see 4 years of losses. You don't see huge returns. You do have some nice years of returns, 16%, 18%, but then you also have years with poor returns. So if we just look at the last 5 years, you lost in 2017, then you had 5%, 4%, 2%, 8%. Again, average business here, nothing exceptional. Return on equity, 7%, return on invested capital, 6% over the last 10 years. These numbers are just too low. You really want to see double digits. If you want double-digit returns as an investor, which I do, my hurdle rate's at a minimum 10%, then I want all these numbers to be at least 10%. Now, return on invested capital, 10% plus. Return on equity, 15% plus. Those are magic numbers I want to hit. We don't make the cut here. So on my standard, it's certainly not a high quality company so far. It's tending towards average or low quality. Now, valuation ratio. I like to buy stocks at a PE of 15 or less. This passes that ratio, so everything's looking good here. Now, with that said, we need to understand are the current earnings sustainable? Are they, a base that you're growing off of? Because you can't simply be at a PE of 15. It needs to be a PE of 15 with a sustainable earnings power. And so when I look at the 10-year CAGR on growth, I become a little more hesitant. You're growing revenue at 6% a year, that's good. Free cash flow at 9% a year, that's good. But you lost earnings over the last decade. So what's going on there? And really trying to understand that is going to be important for the investment case here. So again, you do see some good growth. You're going from $8 billion in 2012 to $14 billion in 2021. That's acceptable. Your gross profit's growing. You've grown basically $1.7 billion in gross profit. But again, you also have years of declines, and I don't like gross profit declines. So you grew from 2013 to 2014, but then you fell in 2015. You grew in 2016, 2017, but then you fell in 2020. Now, 2020 was a weird year, so maybe we forgive you for 2020. But the fact that you have years where gross profit's going down is not good, because what that means is you're going to have really big volatility on the operating profit line, really big volatility on the earnings per share line, which is exactly what we see here. Makes it very hard to plan. Now, they do pay a dividend, and that dividend has been growing over time, and it's not been cut or suspended, so that is good news. But what's interesting here is you're growing the dividend faster than your revenue growth, and you're growing your dividend faster than free cash flow growth, and you're growing your dividend faster than earnings per share growth. Look, you began the decade at $1.09 per share in EPS, and you ended at $1.28. it's basically flat. You've hardly gone up at all. You certainly have many years where it's below. So if you average this out, basically you've not increased the earnings power of this business over time. You have 1 year that's just a complete outlier with $3 in earnings per share in 2016. That's driving this big number here. But again, it doesn't look like it's anything sustainable in the business. There's no clear method that you're able to sustain those numbers over time, and they're going to be, a benchmark you can use in the future. So not a great sign so far. If you're enjoying this video, please hit that like button. Don't forget to subscribe. Your subscriptions help to drive the growth in the channel, and what they'll do for you is if you ring that bell, you can get notified as I upload new videos each and every week covering different stocks, working through every company in the S&P 500, Monday, Wednesday, Friday, 3 videos a week, and you should be a subscriber so you can get those videos. If you like companies that I might have already covered, I have a playlist at the end of the episode here that you can check out to cover those. I've already done over 100 companies in the S&P 500. So look at the income statement. So one thing that we see here is they've grown the SG&A by 50%, but they've also managed to grow operating profit by 15%. That's good. It means you're not having any sort of negative leverage here. You have 50% higher gross profit, 50% higher SG&A, 50% higher operating profit. It just means they're growing revenue in line with the rest of the business. You don't see anything exceptional there. That's neither good, bad, or whatever, but it's just something to think about. Now, what is kind of amazing is you have bought back a ton of shares with this company. You've absolutely been destroying the share count. You started the decade with 1.5 billion shares outstanding. You end the decade with 844 billion shares outstanding, which means you've almost cut the shares in half. Maybe you've cut it by 40% over the course of a decade. That's really, really incredible. What's kind of crazy, though, is that you've hardly grown the net income otherwise. Net income 1.6 billion, net income 2 billion over the trailing 12 months, or 1.9 billion here. There's something weird about this number. And so without that share dilution, your whole growth story kind of goes away. Something is really weird with these numbers. They're not adding up to me. 1.9 billion is more than triple the net income number here, but it's less than triple this number. I guess because there's a massive dilution. Why did they dilute so much in 2020? Oh, so they must have diluted in COVID to survive. See, this is something that you would see with poor quality companies. The reason you want to avoid losses, the reason you want to avoid losing years and poor returns is it requires management doing stuff that really hurts shareholders, like a massive dilution event. Looks like they diluted shareholders by about 20% in 2020. Let's go to the cash flow statement, see if that's true. Net issuance of common stock. They certainly paid a huge amount of stock-based compensation. Look at that. It grew 4x in 2020 and 2021. Here's a large amount of dilution here. It can't be all of it, though. These financing events, I want to know more about what's going on there. But basically, you have massive dilution here of shareholders, and that really hurts your returns over time. Balance sheet. But one thing I need to harp on here, this right here, the fact that they responded to the pandemic that way and they had to dilute that much, that just eliminates it from consideration for me. It means the business is too fragile to avoid situations that like what happened in the pandemic. And I just don't want to operate in a business that's fragile. That is that fragile. They grew PP&E 60%. Again, that's in line with the revenue growth. Nothing to see different there. So overall, nothing exceptional about this business. Corning Incorporated, large business. It's earning a decent amount of money, pays a dividend. It's growing over time. It has a reasonable price. Nothing exceptional, nothing high, but it's just an average business. So the question you have to ask yourself is, would you like to own an average business at what potentially a fair price? Average business, fair price, that's about right. I don't buy average businesses because I want to invest in high quality companies at cheap prices. But if you're okay having an average company at an average price, then potentially Corning is what would be interesting to you. Thank you for listening to this show. Hit that like button. Your likes help tell YouTube that you would like to see more videos like this, that you enjoy this content, and they really help me to grow my channel. So don't forget to subscribe, ring the bell. You can get notified as I upload new videos each and every week. Monday, Wednesday, Friday, we are covering companies in the S&P 500 right now. In the future, we're going to cover more educational content as well. So I hope this is useful to you. If you enjoy this, don't forget there's a whole playlist of S&P 500 episodes coming up at the end of this video, and you can check out that playlist. It's over 100 companies already been covered in the S&P 500, and you can watch the video on your favorite company. Now, if you enjoy the software I'm using to cover this, this is quickfs.net. There is a link in the show notes right there in the description below. First link for quickfs.net. That's my referral link. If you sign up using that link, either free or paid, then I get credit for sending you over to them. But I don't recommend anything that I don't use myself. This is how I use the software. I use this to evaluate companies. It lets me do a 5-10 minute first look, get a really good sense of the numbers and whether I would be interested in doing further work like reading an annual report. If you enjoyed this video, please like, subscribe, and until next time, stop paying fees, start building wealth.